Hi guys, welcome back to another video. In this video we are going to talk about the smart money technique or SMT. The smart money technique is one of the strongest confirmation tools and has the potential to high your win rates. In this video we answer to these questions. What is SMT? When to look for this setup? How to use it? And finally check 2 examples. So let's start. The smart money technique or smart money tool based on ICT trade method. SMT is defined as a crack in correlation between 2 correlated assets. The SMT focuses on identifying divergences between closely correlated or inversely correlated markets. This technique helps traders spot discrepancies in market behavior that can indicate potential trading opportunities. Mastering the smart money technique, SMT, can significantly enhance trading success by predicting price reversals and increasing win rates. Understanding its application with correlated and inversely correlated pairs is crucial for effective trading strategies. The simplest way of identifying a crack in correlation is by spotting a failure swing between 2 correlated assets. The market only turns in 2 ways: breaker swings and failure swings. A failure swing occurs when one of the assets fails to move in harmony with the other, failing to create a lower low or higher high, depending on the trend. For example, if the dollar index is expected to move higher, typically, foreign currencies like the Euro USD or the Pound USD should move lower. Conversely, if the dollar index moves lower, these foreign currencies should move higher. When this expected correlation does not hold, it signals a divergence. To identify the divergence between 2 assets, it's important that they are comparable or related in some way. This means they should be in the same category or have similar characteristics to make a meaningful comparison. For example, comparing 2 stocks from the same industry or 2 currencies from similar economies can provide insights into their divergence. For example, for forex, analyze the dollar index, euro and pound pairs. For indices, focus on the S&P, Nasdaq, and Dow Jones index. For cryptocurrency, consider Bitcoin and Ethereum. So, let's chat about when you should really start digging for these setups and why they can be super helpful in your trading journey. You must understand how to implement SMT into your trading. We look for SMT into key level of high time frame level. That's where the high probability setup will form. Number 2, when internal range liquidity to external range liquidity run. If we combine internal range liquidity and external range liquidity with SMT, we get a very powerful system for determining reversals off of key levels. SMT occurring inside a HTF-FVG is extremely high probability. When an SMT divergence occurs within an FVG, it holds significant credibility. Imagine a scenario where one asset manages to penetrate an FVG, while its related counterpart struggles to do the same. This situation highlights a weakness in the asset that couldn't make the breakthrough. It's like having 2 friends trying to climb a hill. One makes it to the top effortlessly, while the other is left behind, indicating that the latter might need a bit more strength or strategy to succeed. At this point, the question arises, which of the pairs is stronger and offers the better trade opportunity? If we're bearish, we want to trade the weaker asset. We want to short the weaker asset by looking who had a failure swings on the highs. The pair which doesn't make a higher high is weaker than the pair which makes a higher high. If we're bullish, we want to trade the stronger asset. We can identify a stronger asset by looking if it formed a failure swing, or in simple words, it failed to form another lower low. The pair which doesn't make a lower low is stronger than the pair which makes a lower low. Okay, let's check examples on chart. We know that the dollar index is inversely correlated with the euro and pound pairs. If the dollar index is making lower lows and taking out the sell-side liquidity, we would expect euro and pound to make higher highs and take out the buy-side liquidity. However, if the euro fails to make higher highs, or take out the buy-side liquidity, if the pound fails to make higher high, or take out the buy-side liquidity, while euro does, then we have a crack in the correlation between the dollar index and the euro. If everything aligns with a bearish market profile and price has reached a PD array expected to act as a support level, all criteria for a valid SMT are met, signaling a potential reversal in price direction. At this point, the question arises, which of the euro or pound pairs is stronger and offers the better trade opportunity? Since the pound is showing institutional accumulation and no longer pushing higher to take out buy-side liquidity, there is relative strength in the pound compared to euro. This SMT divergence indicates that the pound is stronger than euro, with both pairs signaling a sell. However, the pound is the stronger and safer option for trade. In this example we have S&P, Nasdaq, and Dow Jones Index. All three indices typically move in tandem and are highly correlated. If one of these indices makes higher highs, we would expect the others to do the same. However, if one index fails to make lower lows and doesn't take out the sell-side liquidity, while the other two do, and all criteria for a valid SMT. With a valid SMT divergence in these three indices, it indicates that all of them are likely to reverse, presenting a trading opportunity across the board. But the Dow Jones is the strongest and safest option to buy. The idea behind SMT is that smart money, institutional investors, leaves footprints in the market. By observing these divergences, traders can infer the underlying accumulation or distribution of assets by these large players. This can provide insight into future price movement. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos.